key elements of time value of money. In this discussion of time value of money, we have seen so many elements of time value of money, and we have also seen several applications. These applications are many more. So time value of money is not just a topic in financial management, but it is the very foundation of financial management. Any student who wants to learn finance, financial management, or other topics at the advanced level needs to have very good understanding of time value of money. Here we'll see that what are the various elements which are covered in time value of money and that we need to remember while going through the advanced topics. We started with interest. Time value of money requires calculation of interest. Interest is the additional amount of money that a person gets on his or her investment. The interest is calculated at a given rate, which is called the rate of interest. Interest is calculated in two different ways. One is the simple interest, and the other one is compound interest. Simple interest is the interest calculated on the principal amount invested, whereas the compound interest is the interest on the principal as well as the interest earned. With reference to time value of money, we have a concept of present value and future value. Present value simply means the value of money today, and future value of money means the future value of this amount somewhere in the future. The future value also has a component of interest along with the principal amount. So if we want to calculate the future value, we add interest in the present value in order to get the future value. Similarly, if we want to get the present value of a future amount, we need to deduct the amount of interest from the future value in order to get its present value. Then we talked about annuities. An annuity is a series of payments or receipts of equal amount after equal intervals of time. And if this amount is paid or received at the end of a period, which may be a year or a month or more or less than that, it is called a deferred annuity or an ordinary annuity. Whereas if these payments or receipts are at the beginning, we call it annuity due. We can calculate the present and future values of annuities by using the formulas. An annuity that continues for infinite period of time, that is an annuity that never ends, is called a perpetuity. And it is possible for us to estimate the value of perpetuity in terms of its present value. But we cannot calculate its future value because the future value is somewhere in the infinity. In time value of money, an important discussion is the impact on the present and future value if the process of calculating future or present value, that is what we call compounding and discounting, is done for shorter periods of time. Whenever shorter period compounding or discounting is done, that changes the future value or the present value. And if we keep on shortening the period of compounding and discounting, we reach to a point where it becomes continuous compounding or discounting. So that also has an impact on the future or present value. Considering the shorter period, we also calculated a rate of interest which is more effective than the nominal rate of interest, and we called it effective rate of interest. That is simply by shorter period compounding or discounting, the difference in the rate of interest is called effective rate of interest. And if we want to convert a rate from annual to monthly or quarterly or weekly or daily without changing its effectiveness, then such a rate is called equivalent rate of interest. We've discussed the formulas of effective rate of interest as well as equivalent rates of interest. In practical life, there are several applications of effective and equivalent rates of interest. In practical life, again, there are various cash flows which are neither single amounts nor these are annuities, but there is a mix of annuities and single amounts. We call them mixed cash flows. Mixed cash flows, future value and present values can also be calculated by applying the future value formula or the present value formula of a single amount and annuities. While solving such problems, we need to see that how efficiently we can solve the questions or problems of these cash flows by applying the formulas the minimum number of times possible. A couple of applications of time value of money that we discussed were loan amortization schedules, where we see that in every installment that we pay to return a loan, how much is the amount of interest and how much is the principal repayment and what is the balance. Time value of money concepts are also applied to calculate the amount of installment that is to be paid. So a table or a schedule that gives us the amounts of interest, principal repayment, balance and the amount of installment actually is called a loan amortization schedule, and we also discussed various applications and uses of loan amortization schedules. We also talked about sinking funds, a fund which is created for the purpose of generating a certain amount somewhere in the future. The calculations are somewhat similar to those of loan amortization schedule, but here we are targeting a future amount, so we use the future value of money formula. A sinking fund schedule also is a schedule or a table where we have the amount of installments which is equal amount to be deposited and the amount of interest that will be earned on that installment and the balance which will be there in our accounts. So these were the topics of time value of money and the elements that we have discussed, and we need to keep all of these in our mind while going through the future discussions in financial management.